Okay, what is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, I am very excited to do this video because we are going to be talking about IPOs and whether or not they are a good idea to buy them. What are the risks of buying them? What are the advantages to buying into IPOs? And what are the statistics on your chances of making money or losing money on an IPO, both in the short term and the long term. So I have roughly a dozen stocks or so that we're going to pull up the charts ranging from different IPO dates because we have interesting stocks going IPO this year, dating all the way back to 15, 20 years ago. Some stocks went public, and of course, it's going to make a big difference what time period and what sort of macro environment does the stock go public? Because as you might imagine, like for me, I think 2021 was a very memorable year for IPOs because you had a ton of IPOs, and it was because the market was very hot and stocks were shooting up. 2020 brought in a bunch of new investors, and so all the companies that went public in 2021 raised a whole lot of money, and you had a very good chance of having your stock shoot up, and that's what we saw. And then, as with most things that shoot up really fast and are hyped up, the following year, all those stocks came crashing down. And we're just going to look at different time periods because then there's other time periods. We're going to look at some from like 2000, the 2007, 2008 crash, as well as like right after that period in 2011, 2012, some stocks went IPO, and that was not really a hot market, right? 2011 was kind of after that was when everything crashed after 2008, 2009, and then 2011 things were still kind of just slowly recovering. So it wasn't any insane market during that time. So we're just going to look at different time periods to get an idea of how does that impact the stock. So first one we're going to take a look at here is DoorDash. I do remember this stock going IPO December of 2020. As you can see, it IPO'd at 180 bucks. And like I said, into 2021, of course, it performed well because almost every stock was performing well during that time. And then 2022, most stocks went down, and that's what happened to DoorDash. So if you bought into this IPO, I guess it had a little bit of movement going from 130 to 200. So maybe if you bought at $140 or so, you could make some money in the short term if perfectly traded it. But really, for anybody who held for a year or a couple of years, you were going to lose money, and it took if you let's say you bought at some point around 2022. Well, you didn't end up breaking even again until 2024, right? So in that case, DoorDash really hasn't been a great stock to buy at IPO. It would have been a great stock to buy in 2022, no doubt about that, right? Because the stock went from $40 up to 270, so you definitely would have made a good return there. But for anybody who bought near the IPO price, no, not a good one. And again, keep in mind, late 2020, early 2021 was a hot time for the market. Next one we're going to look at is Levi. I remember when this one went IPO too. I remember thinking, why is this going IPO now when this company was founded in 1853 and the company went IPO in 2019? So IPO'd at $17. Once we had the pandemic crash of 2020, as with pretty much every stock, brought the price down to 12. And so not much you could do about that. But in the first week of the IPO, it did go from 17 to 23, which is pretty good. And then from the pandemic into 2021, it more than doubled. And since then, it's just been up and down. I mean, we're pretty much at the same price we were at 6 or 7 years ago. So Levi is another one where you didn't really wasn't a great time to be buying at that in that period. Next one I vividly remember is Coinbase because this one was very hyped up. And again, at the time, crypto was the hottest thing. 2021, that's when Bitcoin and all this Ethereum, all this stuff was blowing up. And the volume and the growth for Coinbase was insane. And then what happened? All that died down. The stock went to $400, I think, at some point, and it went all the way down to 35, right? So a huge drop. And then since then, again, if you bought pretty much any stock you bought around 2022, you would have made money on. So if you did buy this in 2022, then yeah, you would have made a lot of money. You could have made, yeah, you would have made 10 times your money really just over a 3-year period. So that would have been a pretty good return. But really, look at Coinbase is back down to this price, and it's just the growth is kind of gone. So Coinbase was another one. 2021 was a hot year for IPOs and a hot year for stocks. Not a good time to be buying though in 2021, whether it's IPO or not. The next one on my list here is Uber, another popular company. Went IPO in 2019. So I mean, but look at this though. I mean, Uber went IPO 20 in middle of 2019, and 6 months later, a year later, the stock was down. And that was not a macro thing. That was just this stock. We didn't have the pandemic crash until right here, right in March of 2020. So think about that. It fell in 2022, but really Uber was not another. That was not a good time to be buying that IPO. It would have been smart to maybe buy either 2020 or 2022, as with any stock. Then we have Meta. This is a very interesting one because this is one of the most important, massive companies in the world. And this went IPO at an interesting time, middle of 2012. Like I said, after the whole crash of 2008, 2009, after that stuff started recovering. And then, you look at 2012, it was 38 bucks and it went down over 50% over the next year, right? So Meta, even in an average year like 2012, that was not a good time to be buying Meta stock because it went down to $20. Now, if you bought at 50 and then bought again at 20 and then you were holding, then yeah, from that point on, you did pretty well because then it went to 40 and 60 and 100 and pretty much any time from between IPO in 2012 and all the way up to 2021, you would have made a massive amount of money. You would have made over 10 times your money over that. That's a nine year span. That would have been a very solid return. So Meta is one where since that's an amazing company and had amazing stock performance, you could have bought at IPO, went down for a little bit. Hopefully you don't sell for a loss at that point. Some people probably did though, because 2012 Meta was a much different company. I think that was around the time they bought Instagram, and Meta was much smaller at that point. So if you sold when the stock dropped, then yes, bad, it would have been a bad decision. But if you bought and you were, confident in the stock, then it would have paid off. So Meta could go when you have a great company like that, it could go either way. Then we have Shift 4. This is a not a very I don't think this is a well-known company. I own this. It's a pretty small company. It's $4 billion. I do see a decent amount of hotels and restaurants using their products, so it is out there. It's just not as big as like a Toast or what's it called, Block and stuff like that. So this went IPO in middle of 2020. Okay, interesting time. So kind of when things were getting hot, like I said, and look what happened. The stock went from 30 to 100. So almost a 3x on the stock in 1 year. And then what happened? 2022, everything fell. So you got to look at it kind of like that's why why these companies want to go IPO in these hot times because that's how they're going to raise more money because those IPOs are going to get bought up. So was this a good time to buy the stock? Yeah. I mean, yes, if you it was a good time. I would say it's a good time to buy the stock because that was pretty much the bottom for the stock. It did reach it again in 2022 and pretty much that was the only time, right? So you could look at it like that. I mean, recently it was trading pretty cheap too. Let's see. Recently it just hit $35, so which was the same price back then. But that's why I say being a long-term investor does not always pay off because you could have held this stock for 6 years now and you would have been flat. When if you kind of swing trade it based off of the year and the valuation, well then you could have tripled your money here, bought again at the same exact price, tripled your money again, bought again this year, and then hopefully the stock runs back up to $100 now. So those are just different ways to look at it. Then we have Lululemon, another interesting one that was kind of a trendy stock that has just faced a massive sentiment change over these past couple of years. I think just they've had some problems with the quality of their product, with competition coming out now. I mean, I think back maybe 4 years ago, 3 or 4 years ago, they didn't have as much competition, and then you just have Nike and all these other players kind of making the same thing. But I mean, if you bought this anytime around 2007 to 2018, really, you could make a lot of money on this. So you go back to 2007. This would have been before the financial crisis, right? So interesting time to go public. Well, again, things were hot in 2007, though, right? Things were hot in 2007. They rode that up. So the stock did what? The stock doubled into 2007. Okay. Then what happened? 2008, the stock fell, went all the way down to $3 a share. Okay, just think about that. It went from $26 to 3. Again, timing it plays a big or it went to $2 a share. So timing plays a big roll in this, because then if you would have bought this at two, three, four, five, $6, you would have made a fortune because the stock ended up quickly recovering and going to 60 or $70, and then it kind of hung out in that 50 to 70 range for a good amount of years, 6 or 7 years, which means the valuation got way ahead of itself and had to catch up. Took 5, 6 years for the valuation to catch up. Then we saw another boom from $70 up to 450. And now look at all of that has gone away, and we are back at valuations that we haven't seen in about a decade. Just because the growth is gone, the moat and the growth is gone for this company, and I don't know if they're going to go out of business or if somebody else is going to buy them out. Something like that is what I would picture. But another one, that's just another one where, timing. Okay, now we're going to do a more recent one. This is one I made a video on. This is Bill Ackman's recent IPO, hedge fund sort of thing. And this one IPO on April 29th at $50. And look at this. The first couple months here has been really bad. Went from 50 now we're down to 37. So this is just an example of one where, you know, not this would not have been a good time to buy because you would have lost a good chunk of money here. Then we go to SpaceX, probably the most famous IPO of all time, definitely the biggest IPO of all time. And I mean, look at this one. This one was hyped up more than anything else at 150, it went all the way up to 200, and now we're back down to 150. I mean, and it's only been a month, but still, um, valuation matters. This stock trades at it was trading at over $2 trillion, which some people are going to argue that's justified, but really it's not. And I mean, they might justify that with their earnings 10 years from now, but if what's the point of that? If the stock's going to be worth 2 trillion in 10 years from now, why buy it right now at 2 trillion? The next one is GE. We're going to look at some G because GE did a split between their companies where they have GE Vernova, GE Healthcare, and then regular General Electric. Another very interesting one. This is one of the ones where it would have paid off to invest in this. When IPO at $100, a little over $100, 2 years ago. And what is it today? The stock is over $1,000, which is just insane. So you would have made almost 10 times your money in 2 years. Just insane. Now, how did it work out for the healthcare side of the business? Not as good. Okay, not as good. When IPO at 60, definitely you could have definitely made a lot of money here. There was definitely huge ups and downs if you timed it right. Again, timing, it's all about timing. Uh, if you sold it in 2023 or 20, when it hit these bottoms, that wasn't smart, but you had plenty of times to sell it at a huge profit. So that one worked out pretty well. Then we look at another famous company like ServiceNow. ServiceNow went IPO 2012, like Facebook at $4 or $5 a share. Almost never looked back again. It almost kept going up forever. It just kept hitting new highs every year, every couple of years, and went all the way up to $200 a share. Now we obviously had this huge software crash, and we'll see if it recovers. But that would have been another example of a good one to buy. Then finally, we're going to look at Dollar General. Dollar General. Go back to that IPO. This was in 2009, so right after the financial crisis. And look at this. I mean, so things were probably in 2009, things were beaten down, right? So if you went IPO in 2009, you had a good chance of not having the stock fall, right? You had a pretty good chance of that. That was a very bearish time for the market. And so once the stock got started, 2010, 2012, things started recovering. Dollar General went from a $20 stock to $250, which again, 10x your money in what, 11, 10 years or so. That would have been a phenomenal return. So let's take a look at what Gemini has to say. IPOs are completely different from buying established blue chip value stocks. You're stepping into an environment driven by massive hype, manipulation, and extreme near-term price discovery. What percent of IPOs, this stuff is very interesting. What percent of IPOs fall below the IPO price? Well, according to historical tracking data, for day one, roughly 20 to 30% of IPOs drop below their offer price. Okay. Interesting. So really, most of the stocks are going to go, 75% are going to go up on day one. That's kind of an interesting thing. Even with investment banks stepping in to stabilize the price, about a third, nearly a third, more like a quarter will fall. 3 to 5 year reality. This is more for longer term investors. Over a longer horizon, about 60% of all IPOs lose money and trade below their original price within 3 to 5 years. That one makes more sense because that's kind of what we see. Really, I would have thought it would have been like 80% because based off what we just looked at, most of them fall below, after within 3 to 5 years, most of them fall below IPO price. But 60% is really not that high, in my opinion. So that means you almost have a 1 in 2 chance of 1 in 2 to 1 in 3 chance of if you buy it even at a high price, within 3 or 4 years, it'll come back. Now, close to two-thirds of IPOs underperform the stock market over 3 years. See, and that's where I wouldn't want to be buying IPOs. So, what are the pros? If you're lucky enough to secure shares at the underwriter's offering price before it opens to the retail public, which with the few IPOs I've been trying to invest in this year, it's very hard to get your shares purchased before get the orders through before it goes IPO because so many people are trying to get them. And I've heard that if you place bigger orders, you have a better chance. Who knows? But Robinhood says that's not true, but who knows? The historical average first day pop is 18%. Okay, so if you can get those shares early, you have a 75% chance of making like 18%, which is really good. Every giant company was an IPO once. So one way to look at it is like you can try to swing trade it. I mean, Robinhood will flag you for this, but you can try to day trade or swing trade it and you have a 75% chance that it's going to go up that day. And as long as if you place a bigger order, and I would say you remember it could go down. If it goes down, you want it would be better if it's a stock that you also believe in long term. So something like a SpaceX would have been good. Every giant company was once an IPO. Getting it in the business like Tesla or ServiceNow early can be life changing. Going public forces strict regulatory disclosures. It injects a massive amount of cash into the company's balance sheet, which they can use to pay down debt, fund research and development, or acquire competition. That's true. What are the cons? Well, unless you are using a platform that allocates actual pre-trading, you have to buy one on the open market. This means you are often buying at the absolute peak of the cycle. Yeah, that's true. In the modern era, about 80% of companies are unprofitable, and yeah, I believe that. The founders, early venture capitalists, and underwriters know infinitely more about the cracks in the business, and IPO is mainly just an exit event for early investors. That's also true, but this is where the lockup comes into play. Most IPOs have a 3 to 6 month insider lockup period, meaning insiders cannot sell their shares until 3 to 6 months after IPO. And I experienced this with the Trump coin that came out because the Trump coin was hugely hyped up when that came out last year. And it's not really my style of investing, but I ended up just buying a little bit because it was being hyped up so much. And I lost a bunch of money. I didn't lose a bunch of money. I lost like half of my money on it. Which I didn't invest a lot, but still. The point is there was that lockup period and you got to watch out for things like that. So that is all I have for IPOs. Let me know what you guys think down below, what your strategy is with it, and I will see you in the next video.